Well, the story is going to have a tragic ending, unfortunately.
Peter Schiff on FirstTV this week renewed his warnings about a US dollar crash, higher inflation, and ballooning debt, offering nothing but the worst of outcomes for the United States and the dollar. To start things off, Peter warns higher inflation is not only coming, but here to stay, as well as drawing attention to the massive deficits the US government is running, which has only exploded since 2020.
What we did during COVID, that is the source of all this inflation. And it's going to continue to get worse as long as we continue to run these massive deficits. We're running a $2 trillion a year and rising debt. And this is going to lead to much higher inflation in the future than what we've experienced in the past.
Peter also believes that the CPI bottomed out 2 months ago at 3% year over year. And from here on out, the CPI will continue to print higher, with the latest CPI coming in at 3.7%.
And I think inflation is going to be a much bigger problem in 2024 than it was in 2023.
Peter then points out that the Fed raising interest rates could actually be fueling the rise in inflation thanks to borrowers needing to pass on higher debt service costs to their customers in the form of higher consumer prices.
So every time the Fed raises rates, it puts more upward pressure on the CPI.
This theory may become disastrously true in the near future. In this article from RIA titled The Lag Effect Unveiled, they write that, in aggregate, higher interest rates are currently helping corporate borrowers. As this graph shows, net interest payments for US corporations has fallen while the Fed funds rate has risen significantly. Many companies borrowed heavily in 2020 and 2021 at very low interest rates, and the proceeds remain in deposit or cash accounts, earning more than the interest on the debt. In other words, if a corporation were to borrow to have cash on hand, they can park that borrowed cash in a money market fund, so consequently net interest is reduced. But of course, there is no free lunch. So this happens until the Fed stops raising rates and reaches the end of its rate hiking cycle. Then the lag effect ensues. These show that such a circumstance is common when the Fed raises rates. The red circles highlight 4 instances in which interest costs as a percentage of profits fell while the Fed was hiking rates. The yellow circles show that interest expenses lagged but rose after the Fed stopped raising rates. Such is the lag effect. Most companies spread out their debt, so only a small amount matures in any year. Therefore, it can take time until more expensive debt replaces cheaper maturing debt. This tweet shows a wall of maturing debt is approaching quickly. The US corporate debt maturing wall is coming. The following graph shows what will happen to corporate interest expenses over time if rates stay at current levels. As it shows, corporate interest expenses will triple. This will then get passed on to the consumer, and we will see much higher levels of inflation. Sub 3% mortgages in 2020 and 2021 and meager rates before the pandemic allowed a large majority of borrowers to extend their debt and avoid for a period the wrath of higher interest rates. Over time, however, corporate and government debt matures. People need new cars or houses, and the reality of higher interest rates sinks in. The lag effect is a ticking time bomb. Each day that passes, another borrower feels the impact of higher interest rates. The financial impact is slow but steadily increasing. And also remember that the various types of pandemic-related stimulus are quickly exiting the economy. Normalizing economic activity and the slow but steadily growing lag effect will likely result in a recession. When asked how all of this comes to an end, Peter is not too optimistic.
Well, the story is going to have a tragic ending, unfortunately. We're going to have a dollar crisis and a sovereign debt crisis. The Fed is going to print money until the dollar collapses. And I think that that day of reckoning is at hand because we have so much debt. And as the interest on that debt really rises, then it puts even more pressure on the Fed to print even more money, to buy more bonds, to put some kind of cap on how high interest rates go, and it just accelerates the cycle.
Peter explains that historically, the common path out for a country facing a huge debt crisis is to inflate away the liabilities.
And so we've built this $33 trillion debt mountain, and that's just the tip of the mountain because there's a lot of debt that is unfunded that we still are obligated to pay. Again, Social Security, Medicare, guaranteed pensions, bank accounts, student loans, brokerage accounts. The U.S. government has co-signed a lot of liabilities. And when you add that all together, you're talking about hundreds of trillions of dollars. It is completely unpayable. And historically, the way governments get out of the situation is through inflation. They just print away the value of their liabilities, but they destroy everybody's savings and everybody's, paper assets and their wages in the process.
If you look at what the Congressional Budget Office is saying about the next 10 years, things don't look so good. U.S. debt held by the public will surpass gross domestic product this fiscal year, and interest on the debt will equal about 3/4 of discretionary, non-defense spending, and by 2031, it will be as large. The following graph shows the Fed funds rate and the time as measured in months from the last in a series of rate hikes preceding each recession since 1981. The average delay between the final rate increase and recession has been 11 months. The last Fed hike was in July 2023, so assuming that was the Fed's final rate increase for this cycle, it may not be until June 2024 that a recession occurs.